Transaction number 9, utilities payment of 120. So we have another additional item for liabilities, which is utilities payable 120, and also utility expense, which is on the owner's equity, again minus number, as we haven't paid it by cash. So 10th transaction was that we have actually paid. We can actually combine it, but for simplification we do it in twice. So we have paid our utility expense, and it decreases in here, and we have already recognized that expense. 11th transaction was about sales of inventory for the amount of 4,000, and we had a decrease in of inventory by 2,200. So let's input this as well. So 11, increase in accounts receivable, and also decrease in inventory 2,200. And also we had actually increase sales revenue and decrease cost of goods sold. So again, you may see that. So before we move on to the next transaction, let's make some updates to our formulas. So let's take this all in here and let's copy it, select it, and then from here paste function, we paste on the formulas. So you may see that we have only copied the formulas, we delete the unnecessary ones, and we also update this formula in here in order to capture all the necessary items, and look for this one. So as you may see, we have a balance in our balance sheet. So far we are good. So 12th transaction was about the interest expense. Let's recognize this as well. So we had interest payable. Let's add another column for that. So interest payable for the amount of 133, and interest expense, which is decreasing the owner's equity. So let's add this item as well in here in order to get this formula correct. So again, we have a balance. Let's save this before moving on. Alright, so third transaction number 13 about rent. So our prepaid rent decreased by 1,000 for months of January recognition, and we also incurred rent expense, which is also decrease in owner's capital. Again, balance in our transactions. Having updated our balance sheet, let's move on to the next category of balance sheet, which is depreciation. Depreciation is actually allocation of expenses of long-term assets. So in our case, we have equipment, as you may see in here, of with a worst value of $25,000, and let's assume that it has a useful life of 10 years. So let's calculate our depreciation for the month of January. So we recognize that depreciation will decrease our assets value. So our assets value is 25,000 of historical cost divided by 10 years of useful life, and then divided by 12 months. So approximately it makes 208, and it's a negative number. So decrease by 208 for January month, and also depreciation expense in our owner's capital, which is the same amount. Now let's go back to the previously mentioned example on unearned revenue. So let's assume that for this $100 that we have received, we have actually rendered the service at the end of the January. So let's input this transaction for 15. So our unearned revenue has actually decreased by the same amount that we have actually inputted, so 100, and we recognize actually this revenue as a sales revenue for 100 at the end of the January. Again, we follow the principle that the revenue is recognized when it's actually realized, meaning that when the service is rendered or the product is actually delivered. So let's update our balance sheet for this transactions. So we had a decreasing of equipment, which is number 14, 208, and we had depreciation expense, which also decreased our owner's equity. And the last one was about, and for the last transaction, let's input the first, the 7th transaction that we actually skipped in our previous update. So we have received cash and we have recognized unearned revenue in our liabilities side. So it's 15th transaction, we have received cash, and for liabilities, let's add another line, unearned revenue, again 100, and the last transaction will be recognition of unearned revenue, which will decrease. So we have delivered the service and we have recognized the revenue. Again, these two figures, you may see we have done everything correctly and we have the formulas in place, so we have the balance. This will end our session for chapter 2, basic concepts of financial accounting. Thank you for your attention.